Hey everyone, welcome back to another dividend investing video. As the year wraps up, it's normal for things to start to slow down. The holidays kick in, spend time with family, friends, and the things that matter. But regardless, my own investing plans as a dividend growth investor hasn't skipped a beat. I'm not slowing down at all. I am still focused every single week on growing my wealth via a stream of growing passive dividend income. And with about 80% of the positions in my stock portfolio in the green, after the run-up we've been seeing here at the end of 2023, it's getting harder to find value, but as we end the year, I've identified 3 stocks in particular that I'm going to be buying into during this holiday season, and I'll share my rationale in today's video. So let's get into it. I'm Nick, and this is the Dividend Growth Income channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. The first company I'm buying in December is Chevron, ticker CVX. The Chevron Corporation, they're an energy company based in the Bay Area of California, originally known as Standard Oil Company of California. It is active in more than 180 countries. Chevron has had a down year while the S&P 500 grew 20%. Shares of Chevron are down about 14% year to date, and shares aren't too far off from their 52-week low. I think this could be an opportune time to be adding to my own position right now. On a 10-year basis, Chevron brought in a total return of 83.5%. Now, this is about 40% of what the S&P 500 brought in, but compared to ExxonMobil, its larger competitor, as well as the XLE Energy Sector ETF, which covers the entire energy sector, Chevron has been greatly outperforming both of these. And this is another reason I prefer Chevron to some of the similar choices we have when we're investing in energy. And energy is tricky, tied heavily to what oil prices are doing, and often global conflict is going to play a role. And we know there's none of that going on right now, right? So Chevron is trading at a forward PE of 10.5. This is a 17.9% discount to its 5-year average. It's also a slight discount to the energy sector as a whole. Shares of Chevron are yielding 4.04%, which is right in line with its 5-year average, suggesting shares of Chevron are valued reasonably today. Chevron pays out a quarterly dividend of $1.51 in the months of March, June, September, and December. In fact, I just received my December payment, which was just reinvested. So that's a total annual payout of $6.04 per share. The dividend makes up 42% of forward earnings and 41% of forward free cash flow. So this is right about where we would expect it to be for an oil company, where we want it to be. Simply Safe Dividends provides Chevron with a very safe dividend safety score of 90, suggesting a dividend cut is highly unlikely. Chevron's been paying this dividend uninterrupted for 111 years, and for the last 35 years, they've been growing the dividend every single year. So this gives me a lot of confidence holding Chevron in my own portfolio. They've been paying these dividends before my grandparents were even born, and their latest dividend increase was at 6.3%. This is in line with what they do typically with a 5-year average annual dividend growth rate of 5%. Chevron is due to announce a dividend increase in the first quarter of the new year. Now, one thing I love about Chevron's management is that over the last few years, they've done a great job lowering their debt, particularly important in today's era of high interest rates. They have a net debt to EBITDA of 0.29 and a net debt to capital of 0.09. Wall Street analysts generally love Chevron. They rated a buy 4.2 out of 5, with 19 analysts rating the stock a buy and 6 a hold. And the average analyst price target is $178.86, which would represent nearly 20% upside from where shares are trading today. You get a 4% yield, high single-digit dividend growth. They provide a necessary product to folks all over the globe. Much of the world depends on Chevron in some way or another, and I don't see their leadership in this space going away anytime too soon. Oil is a tricky investment, one I never want to go too heavy in, but it does have its place in a diversified portfolio, in my opinion, and Chevron is a solid pick. The next stock I'm buying up as we end the year is Aflac, ticker AFL. Now, as I was evaluating my portfolio over the last month of the year, I noticed I'd not been adding quite enough of this one, so I'm fixing that now. Aflac is an American insurance company and the largest provider of supplemental insurance in the United States, providing financial protection to more than 50 million people between the United States and Japan. Aflac had a solid 2023. Year-to-date shares are up about 13.5%, and while I've been more focused on my positions that are in the red in 2023, This is one of my green ones that I'm very happy to boost right now. Zooming out, looking at the last 10 years, we have a total return of 212%, which mirrors exactly what the broader market has done, interestingly. Aflac's forward PE ratio is 13.1. It's a little bit above its 5-year average, but not what I would call an expensive territory. It's also a little higher than the financial sector median of 11.2. By dividend yield theory, Aflac looks reasonably valued. Shares are yielding 2.46%, exactly in line with the 5-year average. So you can see I've been more focused on places where I saw value, but there is so much to like about Aflac as a dividend growth stock and long-term investment that I'm happy to acquire this one at a reasonable valuation. The quarterly dividend from Aflac is paid out in the months of March, June, September, and December, the amount of 50 cents, for a total annual payout of $2. Plenty of time left to get your shares for the next ex-dividend date of February 20th. You get paid on 1st of March, 2024. The dividend makes up 32% of forward earnings, leaving little concern to the current safety of this dividend, and free cash flow is really not a meaningful metric when looking at insurance. Simply Safe Dividends gives Aflac a dividend safety score of 99, rated very safe and highly unlikely to face a dividend cut. The track record here speaks for itself: 40 years of uninterrupted dividend payments and a 40-year streak of consecutive dividend raises. For a mature company like this, they are showing healthy dividend growth, with 5-year average annual dividend growth rate of 13%. And their latest raise was announced this last month. I mentioned in our November portfolio wrap-up video, 19%. It's a real gift to AFL shareholders. I really love when I see companies with strong dividend growth plan also executing on returning shareholder value via buybacks. In the last decade, Aflac has reduced its outstanding share count from 935 million shares outstanding to 608 million shares outstanding. And that's a share count reduction of 35%. There's lots to love, but not everything is rosy. Debt is edging on the high side for an insurance company, and its return during the last recession was negative 80%. It got destroyed, far worse than the broader market. So those are some things you want to consider before making an investment. Wall Street analysts give a price target of $79.50. If Aflac spends 2024 as a down year, it'll make it better for long-term accumulation. And I'm going to continue growing this position here in the end of 2023 and hopefully throughout 2024. I see it as taking a larger role in the portfolio. I'm feeling confident in the dividend safety with a low payout ratio and the company's ability to continue growing at an above average rate. So I'm going to continue adding to my position this week as I'm posting this video. All right, and the last stock I've been buying up here in December is Realty Income, ticker O. Realty Income is a real estate investment trust that dubbed itself the monthly dividend company, as they've been paying monthly dividends for over 640 consecutive months, along with 104 consecutive quarterly dividend increases. 2023 was a horrible year for REIT performance, due in large part to the rise in interest rates. But for long-term investors, I think this was a gift. They own the property for the grocery stores, convenience stores, home improvement, restaurants, gyms. And they've even more recently got into gaming with their recent investment in the Las Vegas Bellagio. They have an impressive 99% occupancy rate. This is one of my favorite companies. It just makes it a no-brainer for a dividend investor. Year-to-date, shares are down 11%. It's not quite at the discount it was a few months ago when it was in the 40s. I think there's still a ton of value at this price, especially at this range, for the long term. The 10-year total return from Realty Income is 146%, which is respectable. It does fall short of the broader market, but you're buying this one for those monthly dividends. I think this is a solid rate of return for the last decade, especially given what's gone on in the last year. The O's price to adjusted funds from operations is 13.7, and this is a solid discount to the 5-year average of 18.0. Talking 23% discount. From a dividend yield theory perspective, O looks undervalued. The 5.45% yield is 24% above the 5-year average of 4.39%. I'm going to continue building up my position in O while it is above that 5% yield. Below that, I'm going to pause and hold until it gets back to that level. Not financial advice, it's just how I personally look at my own position in this particular stock. Loving this monthly dividend schedule. Right now, shares are paying 25.65 cents per share, following the trend of short quarterly dividend raises. The total annual payout is $3.08 at the time of publishing. And remember, these are non-qualified dividends taxed as ordinary income, and you have through December 29th to get in on that next dividend pay date of January 12th. As a percentage of adjusted funds from operations, Realty Income's dividend only makes up 75%, and they've done a solid job continuing to lower this payout ratio, setting them up for being able to continue growing both their real estate portfolio as well as their dividend payment. We have a Simply Safe dividend safety score of 80, rated safe, suggesting Realty Income is unlikely to see a dividend cut. That would sure be embarrassing if a company calling itself the monthly dividend company was somehow forced to cut their dividend. So I think they're going to avoid that. I don't see any cause for concern. We're talking about 54 years of paying uninterrupted dividends and 28 years of consecutive dividend raises. Realty Income is a dividend aristocrat. And over the last year, that dividend has grown by 4%. So kind of slow, but very consistent. This one is for people who want some current income. Adjusted funds from operations per share has gone up every year, and this will help fuel that future dividend growth. Also, just a couple months ago, Realty Income announced it will acquire its smaller competitor, Spirit Realty Capital, in an all-stock transaction valued at $9.3 billion. It's about 25% of O's market cap. The deal should close in Q1 of 2024, and nothing points to this having any impact on its dividend policy. We have an analyst average price target of $61.77. This represents over 9% upside from where shares trade today. I think when the day comes and rates start to get cut, and that day is coming, there's going to be a bunch more upside to be had. And I sleep well at night putting my money to work in these properties. Beats being a landlord, I think. And I purchased some O this Monday, and actually I added over $1,000 in my Roth IRA just to Realty Income over the course of 2023. And I think 2023 was a great opportunity for Realty Income. Many other REITs, I think the value is still there. I'm going to be looking to add more in 2024. And I do have a video coming in the next week about my top 3 REITs for 2024. So let me know down in the comments, what is on your buy list this holiday season? And I have my 2024 weekly investing challenge video also coming out, and it's going to include a gift to you, my subscribers. We're over 20,000 subscribers strong, and it's a pleasure to make this content for you guys, sharing how I'm focused on building my wealth and buying back time. I'm just hoping my journey helps inspire you. Now, if you want to know what stock I purchased the most in the year of 2023, just click into this next video where I share where I put over $5,000 of my money in 2023. Thanks again for watching, and until next time, keep investing.